The history of money and what comes next. Level C1. Advance. Money is the most powerful fiction humanity has ever agreed to believe. It shapes empires, directs wars, builds societies, collapses markets, and silently governs everyday choices. It is not gold, paper, or numbers on a screen. It is trust collective, fragile, and constantly renegotiated. The story begins long before coins and banks. Early human societies measured value through obligation. A hunter shared meat, another offered tools later. Reciprocity tied communities together, and memory itself functioned as a ledger. But memory is limited. As populations grew, value needed a physical body. Shells, beads, salt, cattle, anything rare and portable could represent debt and desire. The object was less important than the confidence people placed in it. When metal entered the system, money gained not only durability, but mythology. Gold and silver were not just precious, they were divine. They resisted decay, glittered like celestial bodies, and seemed beyond time. Ancient rulers understood the psychological power of metal and began stamping their faces onto coins. Currency became sovereignty in miniature. To hold a coin was to hold the ruler's promise or threat. Economy and authority merged into one emblem, small enough to fit in a palm. The Middle Ages accelerated this union. As trade routes stretched across continents, coins traveled farther than kings ever could. Yet precious metal was heavy, vulnerable to theft, and finite. That is why merchants developed an astonishing innovation: paper that claimed to represent gold stored elsewhere. A note was not wealth itself, but evidence of wealth. Anyone who trusted the claim could accept the paper without ever touching the metal. Slowly, quietly, abstraction entered the bloodstream of civilization. By the 17th century, this abstraction matured into central banking. Governments realized that money could be expanded through credit, that numbers could multiply faster than gold. Debt became not a flaw, but a formula. Nations financed wars, industry, and colonization through promissory value. Money no longer waited to be mined. It could be imagined, issued, multiplied. With the Industrial Revolution, money assumed a new metabolism. Factories demanded wages. Wages demanded schedules. Schedules demanded time measured in currency. A human hour became a unit. The clock tower was not simply architecture. It was an economic instrument. Wealth production moved from land to machines, and profit replaced harvest as the rhythm of life. The 20th century brought the unthinkable, the end of gold's dominion. In 1971, the United States abandoned the gold standard, and the world followed. Currency became pure negotiation, floating, volatile, unanchored. Some called it liberation, others called it illusion. Money was no longer tied to matter, but to policy, speculation, and sentiment. The value of a dollar or franc or yen existed because governments insisted and people complied. The digital age intensified this detachment. Most money today does not exist physically at all. It is stored in servers, flashed across trading screens, converted into code. A transfer of millions takes seconds, not because wealth moves quickly, but because wealth is now only information. The world's financial system hums invisibly in algorithms, interest rates, and derivative logic that few fully understand, yet everyone depends on. At this point, the question is inevitable. If money has evolved from shells to coins to banknotes to pure data, what comes next? The answer is both predictable and disquieting. The next form of money may not be national or physical or even purely economic. It may be behavioral. Already, society experiments with the fusion of identity and currency. China's digital yuan integrates payment with surveillance. Western markets reward or punish credit scores with access to life itself, housing, loans, healthcare, dignity. In tech culture, loyalty points and subscription ecosystems create closed microeconomies where money functions like citizenship. People pay with more than cash. They pay with their data, habits, and time. Cryptocurrency enters this narrative not as rebellion but logical evolution. When Bitcoin emerged, it promised decentralization, trust distributed across countless machines, rather than a throne or a central bank. It created value through algorithm rather than decree. Yet, even as cryptocurrencies sought to liberate money from government, they fell into the same ancient trap: belief. Volatility, speculation, and narrative determine their worth as much as any ledger. Blockchain may be revolutionary, but it still runs on confidence, the same invisible fuel that powered seashells and gold coins. If money has always been a story, the contemporary version is written faster, louder, and more dangerously than any before. Markets react not to crops or resources, but to tweets, rumors, and expectations. Value shifts in milliseconds, sometimes erasing billions before breakfast. Wealth is no longer stored, it is chased. Financial systems no longer observe time, they accelerate it. What has changed, then, is not money's essence, but its velocity. Trust used to travel by horseback. Now it moves at the speed of electricity. The result is both intoxicating and unstable. In the next part, the question moves from history to implication. What does it mean to live in a world where money is no longer tangible, where currency is indistinguishable from identity, and where economic power belongs less to nations than to platforms? The future is not gold or paper or even crypto. It is algorithmic belief. Whether that belief liberates or enslaves will depend on who writes the next chapter of value. To imagine the future of money, we must accept a reality that feels strangely intimate. The next currency may not live in our wallets, but in our identities. In a world where transactions are instantaneous and limitless, money is no longer the medium through which we buy it. It is becoming the metric through which we are judged. When value becomes data, individuals become portfolios, not of wealth, but of behavior. The 21st century marks the shift from possession to participation. Traditional banks no longer stand at the center of financial life. Instead, platforms do. Apple Pay, Alipay, Amazon, Meta, PayPal. These entities are not simply payment intermediaries. They are ecosystems. Once inside, a user no longer merely buys. They exist through the platform. Their preferences, movements, social circles, reading habits, even sleep patterns become tradable indicators of reliability. Currency becomes reputation. This is not unprecedented. In medieval Florence, the Medici Bank extended credit based not just on gold, but on family names, alliances, and political networks. Today, algorithms perform the same judgment, stripped of human context but saturated with precision. The system does not need to know your honor. It needs to know your pattern. It measures risk not in morality but in mathematics. Cryptocurrency promised to liberate this relationship by replacing trust in institutions with trust in code. Yet the irony is stark. The blockchain ledger, immutable and transparent, creates a world where every transaction is eternal. What once disappeared in the anonymity of cash now persists in digital stone. Privacy becomes not an expectation, but a premium product. A future in which wealth is public and identity is audited is not liberation, it is exposure. Still, crypto pushes the narrative forward. It proves that money can exist without borders, without banks, without kings. But it also reveals that decentralization is not inherently democratic. Mining, governance tokens, and exchange control concentrate power not in governments, but in technocracies. A digital wallet can hold sovereignty, but sovereignty becomes server-dependent. Then comes the next evolution: programmable money. Digital currencies issued by central banks do not merely represent value, they execute it. Funds arrive already tagged for purpose, time, or expiration. A citizen might receive energy credits that cannot be spent on luxury goods, or stimulus funds that disappear if unused. Money becomes policy incarnate, not suggestion, but command. If currency can control where it moves, it can also control who moves it. At this threshold, the question becomes philosophical rather than economic. If currency governs action, not exchange, what remains of freedom? When financial identity merges with civic identity, dissent becomes expensive. The cost of non-compliance is exclusion. From networks, from services, from daily participation. Access becomes the new wealth. Those who possess it do not need millions. They need permission. Paradoxically, the same transformation produces opportunity. If money sheds its physical body entirely, economics detaches from geography. A coder in Nairobi can earn in Tokyo, spend in Sao Paulo, and invest in Singapore without crossing a border. Nations compete not for land, but for users. Citizenship itself may become subscription-based, paid or earned through contribution. The marketplace turns planetary, not because travel expands, but because jurisdiction collapses. And yet, beneath this turbulence, one force remains consistent: story. Money works only because a population believes in it. Gold glittered because people desired permanence. Paper succeeded because people desired ease. Credit succeeded because people desired possibility. Digital currency succeeds because people desire speed. Each era invents the currency it emotionally requires. The next invention will respond not to need, but to identity. A future currency may not measure what one owns, but who one is: loyalty, sustainability, creativity, influence. Already, artists, streamers, and influencers mint value through presence alone. In this sense, money returns to its origin: community trust as wealth. Except now, community is global, invisible, and quantified. If money began as memory, it may end as mirror, not reflecting prosperity but personality, a ledger not of assets, but of self. The danger and the promise intertwine. A society where value depends on transparency may demand virtue. It may also punish imperfection. History warns that when worth becomes moral, judgment replaces justice. What comes next, then, is not merely a new currency, but a new anthropology. Humans once traded goods. Later, they traded capital. Now, they trade identity. The question is no longer how money will change, but how much of ourselves we are willing to convert into value. Money has always claimed to measure the world. Soon, the world may measure itself through money. Whether that results in cooperation or control, equity or exclusion, depends not on systems, but on stories. Because, in the end, currency is not metal, paper, or algorithm. It is belief shared at scale. When belief shifts, history follows. Money is a fiction made real by agreement. And as long as humans continue to rewrite their agreements, they will continue to reinvent their wealth.